Good morning, everyone. Welcome to this market update for the 27th of May. Somewhat quiet week leading into Memorial Day holiday in America on Monday night. But really, everything is looking pretty strong. Earnings season was great, and the price action is now settling down quite a lot. So let's jump in and have a look at the update for this week. So basically, not a lot happened on the market in terms of net movement. Markets really just consolidating the recent gains they've made in the last couple of weeks since we came off the lows. But really, when you look at all the fundamentals and the charting patterns, all the boxes are getting green ticks at the moment. It's very hard to see why the market won't continue to either stay where it is or progressively move higher. And of course, we'll look at the normal stock and commodity trends. Portfolio analyst last week did a recap of a lot of the winners that have appeared in Portfolio Analyst in recent months, and it's a pretty impressive list, I must say. So the backdrop for global markets at the moment is that there was a buying climax into January. So we had a fairly smooth and steady uptrend during 2017. That really accelerated quite dramatically in January as everybody rushed to one side of the boat. And ultimately that just had to correct. Those sort of buying excesses rarely last very long. And so by the end of January, we had quite low cash levels and fund managers were very bullish. Now, all that has reversed very, very sharply in basically the first couple of weeks of February, and it hasn't really come back yet. And cash levels now, paradoxically, even though we have moved higher, cash levels now are more like a market bottom, and sentiment is more like a market bottom than it is a market top. So it's been quite a dramatic swing from very, very positive at the end of January to, it's back to quite nervous markets at the moment. And this is a very bullish sign. Now, earnings season was the highest percentage number of beats since 2008. I think it was about 79%. But even more importantly, the earnings growth rate was the blended growth rate for the S&P companies was 24.6%. Now, that was helped a bit by some significant gains in earnings growth rate by the energy stocks, but nevertheless, they only form a more minor part of the market. And this was the highest earnings growth rate since 2010. So there's absolutely no question that this earnings season has been an absolute cracker. And on top of that, the S&P is only trading at a PE of 16.2, which relative to the current low interest rate environment, I think is even erring a little bit on the cheap side. It's certainly not overvalued, that's for sure. So earnings season was terrific. The outlook is great. The forward earnings guidance was very strong, and valuations are okay. So it's really a very good backdrop at the moment. Now, American stocks, the index was up by just 0.1% for the week. I think it was about 8 points, so not a lot happened there. And it's really just this consolidation that we typically get after a real blow-off in prices. And I think I said at the time that it was likely that this consolidation would last for anywhere between 3 and 6 months. We're now 4 months into it, and so we might still have another couple of months with the index basically just moving sideways, maybe slightly higher. And of course, individual stocks in the best sectors that I've been highlighting will do much better and are doing much better. Now, the small caps continue to lead in America, and that's really a bullish sign that the market breadth is really up there. You don't get markets that are looking a bit shaky when the Russell 2000 is leading the way, so that continues to be very bullish. And you just have to conclude that the path of least resistance is to the upside. It may only be to a minor degree at the index level for a little bit longer, but that's the way that it's heading. Now the US dollar is still trending sharply higher, and we saw the bond, 10-year US bond slip back under 3%. So it's interesting that despite the fact that the bond yield slipped back from 3.1 back to 2.93, that the US dollar actually kept rising, because most conventional wisdom would have you think that the US dollar is rising because their interest rates are rising. And of course that generally happens at a longer term picture, but in the very short term, anything is possible. So let's jump in and look at some of the charts. We'll start with the S&P first of all, and you can see this is the last 2 weeks. So we've basically managed to move up and out of this triangle. We've formed new short-term highs, so we managed to get above this little April peak, and it's being sustained at that level. And I think we'll just continue to perhaps slowly work our way back towards these levels here, but I'm still very much of the view that we will see new all-time highs above 2,900 in the not too distant future. Don't know exactly when, but I think we'll certainly see it this year. So that's all very positive at the S&P level. And of course the 200-day moving average is still rising, really pretty much unaffected. When you look at the angle of that red line, it virtually hasn't changed, even though we've had this dramatic consolidation. And that was because we just got, the markets just got so far ahead of themselves so quickly. Now, if we look at the NASDAQ, also doing very well. So this is the QQQ, and you can see that really the angle of the trend, even though the volatility has picked up, the angle of the trend is still almost exactly the same as what it was through 2017. And that's the interesting thing, that we've gone from 1% and 2% swings either side of the trend line to now we've had 8 and 10% swings on either side of the trend line, but we're basically still on trend. And as the fluctuations settle down, you can see that they're settling down right on the trend line. So really nothing much has changed there at all. Earnings growth rates in technology were right up there with the strongest parts. Of course, that energy was a bit of an outlier coming off a very low earnings base. But putting energy aside, earnings for the technology sector were very strong, and the outlook for technology really does look very, very good. Turning now to the Russell, we've managed to set new all-time highs, which of course is ahead of the S&P, the NASDAQ, and the Dow. So that's a really, really bullish and positive sign. The US dollar, as you can see, really did pick up, particularly the last 3 or 4 days when the bond rate turned down. So that's a bit of a head scratcher. But look, perhaps you could say that this is just playing some catch up, that the US dollar should have been heading higher with the bond rate earlier, and now it's just catching up. There's resistance up here, but we've still got a little bit of a way to go yet. Now, I just want to do something additionally. I want to look at the energy sector in particular, because I did say last week that we were probably getting to a resistance level where you needed to be careful, and that the energy sector had run very hard and was probably due for a bit of a pause. Well, we certainly got that through the week, and I just want to take a look at the overall energy sector and one specific example. So this is XLE, which is the overall ETF for the energy sector. So it includes the oil and gas producers, it includes the refiners, and it also includes all the service companies. So we formed a high in December, the middle of December of 2016. We then formed another high on the 23rd of January 2018, and then we've just challenged it again. Now, we had a minor little new high. As you can see, we just managed to peak over the top, so a little bit of a sign of strength there, and then it all it all fell apart in the last couple of days, and you can see, and that was with the oil price coming down sharply from around 72 down to 67. So that was the reason for this sort of dramatic pullback. But we were at resistance, and it was struggling to get through there. Note the gaps in particularly into Friday. Let's look now at the oil services sector. So the oil services sector, very similar sort of pattern, but not it lags the overall energy sector by a little bit of a distance. The peak in December, which is around here, was significantly lower than we saw in the overall energy sector, but then we did play catch up through January. But we formed the same January peak and just recently as well, and we've come off quite sharply in the oil services sector. Now, when you get gaps like this, so we had a gap into Wednesday, we had a gap into Thursday, and then an even bigger gap into Friday, this isn't rebounding in the next couple of days. So whilst I think the energy sector is one that you should be considering having exposure to, this is a little bit like the S&P. It may not take quite as long to play out, but the market did run very hard for a period of time, and it's likely that that it'll be several weeks yet, and maybe even a bit longer before the final lows are seen in this sector. So that's the oil services sector. Now I just want to look at one of the oil and gas exploration and production majors. This is ConocoPhillips. So first of all, I want to look at this on a weekly chart, and I want to, I guess, give you a way of looking at the price action rather than just a series of squiggly lines and red and green bars. And putting this sort of structure around the price action really helps you see when trends are starting. So the first thing that we want to do is to put some boundaries around the initial decline. So the initial decline down into here, which occurred on rising volume, you can see here that the volumes are rising. And then we want to see where it bounces to. So we get a bit of a bounce up here. So that gives us some structure to the initial decline and then the first bounce. Now we then get a concerted sell-off, and you can see considerably higher volume. So that was some serious selling occurred into the early part of 2016. So this consolidation started around August of 2015. We then bounced back, and you'll notice that we managed to spend most of the time then around that support that was created by the initial decline. And it's really what we're looking for is for this price action to settle down and then show signs of starting to actually mark up and rise higher. So really nothing much had changed here. We continue to respect the support around $41 that was created back in 2015. So by September 2017, so 2 years later, we're still holding around the same lows. We then managed to move above this previous high in November of 2017, and then we managed to exceed the previous initial high up here. So here's our sign of strength. Here is the first sign in January of 2018 that that this stock was basically changing character. It was coming out of a 2.5 year base, and it would be starting to head higher. Now, as is often happens, you get an initial breakout, and then there is some selling back into the range, but this was a relatively shallow decline. It only came back to this previous peak, readily found support, and then moved higher. And you can see as it moved up and out of this consolidation base that we actually started to see the volumes rising again. And the other thing that we saw is it's really starting to outperform the S&P index. So this is the relative strength index here on the bottom. And this is all the sort of analysis that that I do in the training course and in Portfolio Analyst, if you want to access some more of this. So very clearly to me, this is not a recommendation, but just an example of how to look at price action. Very clearly now, ConocoPhillips, along with a lot of other stocks in this sector, are moving higher, and I think it's incredibly likely that we're going to go up and challenge these highs up here around $86. However, it had got ahead of itself. It had got well up above the moving average, and so a period of retracement is going to occur. Now let's just zero in on this area here and look at a daily chart just to get a sharper short-term perspective. So here's the same structure, but we're now looking at it on a daily chart, and you can see that we had really a significant increase in volume. You look at the average volumes through here compared to back here. So the volumes on the breakout were significantly better. So the potential entry opportunities. So here's our sign of strength. You then wait for a pullback. Potential entries once we see some stability. So here was a very positive candle here on the 14th of February. That was an entry opportunity. Now it didn't quite get going for a little bit longer. Here was the next entry opportunity on the 21st of March. So the whole process here is not about predicting. It's not about guessing. It's just basically letting the market show you the way and go with the strength. So one opportunity on the 14th of February, another opportunity for entry on the 21st of March. These are around the $57 mark. And then the real markup phase started and the price got up to 71. We're now getting a pullback. I don't know at this stage. There's not enough information for me to know where it's going to pull back to. But I would expect that if it gets down to here, this level here, around 61, will probably provide support. So I hope that helps for those that do their own market technical analysis, just in terms of how to interpret the price action that you're seeing. Now moving on to Aussie stocks, the Aussie dollar was up a little bit, which is a little strange considering the US dollar also went up, and also commodity prices were higher. Commodity prices were actually a bit lower. We saw oil come off very sharply, and we saw iron ore down, and yet the Aussie dollar rose. So that's another head scratcher in currencies, and it's one of the reasons I don't trade currencies, because I don't see the clear linkages as I do in the stock market. Now the ASX 200 index declined by 54 points, just under 1% for the week, and it was pretty broad-based. Energy was down, resources were down, banks were down. So not a particularly pretty picture there in the Australian market. And CBA, as we'll see, is still sitting basically on the precipice and looking like it's about to fall apart any minute. So here's the ASX 200. So we managed to break above 6,000. We've held above there now since early May, but we're back down now, threatening the 6,000 point level. Let's just look at CBA, and I think looking at it on a weekly basis is probably the most appropriate one. So we've had this big consolidation range that started in August of 2015, so we're getting on now for 3 years, and you can see we've got a series of lower highs and also lower lows, and we're also just breaking support. Now it's not definitive yet, because sometimes prices can break support by 3 or 4 or 5%. That's the computer robots that are searching for the stop losses to trigger, and then it can turn around and go back up again. But the fundamentals don't look particularly enticing, and I think you'd have to say that the probability is that CBA is heading lower. And if we do get a break of this level, then that could bring a real rush of technical selling into the market. Just while I'm here, let's look at the gold price. So there's the gold price on a daily basis. We managed to make a net gain for the week. I think it was around about the $10 mark. But if you look at it on a weekly, we're still in the situation of we've got higher highs and higher lows, and we have had, that's been the case really since December of 2016, but unable to break out yet. 1380 is a key line in the sand. Let's look at GDX, and as you can see, just nothing happening there at all. So GDX has just been mired in this big sideways range since November of 2016. So gold higher by 9 to 1301. A little bit of fear back with the over North Korea and over the China trade negotiations. And precious metal stocks, no net movement. Turning to other commodities, copper wasn't down and steady; it was steady at 311. But crude oil fell sharply to 67.88. And I did note last week that now was not the time to be buying into the energy sector, and that certainly proved to be the case as we saw very sharp selling from overbought. But the don't abandon the energy sector with these significant falls. I think the clear indication is that the energy sector is heading higher. There's the spot copper chart, and there's the oil chart. Came off from above around about 72.5 back down to 67.8. So to wrap it all up, as I've been saying now all year, stay focused on the strength. You want to tend to look for companies that are, closer to setting new 52-week highs than certainly trying to bottom fish at the moment, because it's not how the institutions do it. They look for the stocks that are outperforming the S&P, and that's where they go. Wait for the dips to support. I think that's a really important part of the process. And portfolio analysts this week, I was going to do China last week, and the inclusion of China A shares into the MSCI global tracking indices. Because of other things that I didn't get to that, but China will be in the mix for this week for portfolio analyst. There's my contact details for those who aren't members, and I will be back with you again next weekend. Cheers.